All right, let's get started. Today is Monday, September 11th. This is the 2 p.m. section, somber day. This class is being recorded. So first and foremost, here is the sign-in sheet. Should be the corrected one. Please make sure you sign the sign-in sheet before you leave today. Tracking attendance. All right, so as we get started, first I want to talk about the Bloomberg Trading Challenge, which should be in full swing after last week. So if we go to Bloomberg and we type in either IDEA or TMSG, that will bring us to the challenge. Select your section in the drop-down. This is section 201. So there are the 6 teams plus myself. You are going to be eventually scored on portfolio value. Okay, so at the end of today, everybody has to be less than 300,000 in available cash. So basically, the final team, P. Manivel, you're going to be disqualified today if you don't get under 300,000. I know it's 300,286, but 300,000 is a hard standard. So that number can't have more than a 2 in it the rest of the semester. All the other teams are get there. So by the end of the day, go buy something else. Okay? Now, in the first half of the semester, you have to have at least 10 longs. Many of you have gotten most of that through today, but again, you got to be at least 10 different stocks over the first half of the semester. That requirement is by mid-October. Okay? But as of the end of today, this has to be under 300,000. Okay? The way you're going to be scored is on this category, portfolio value. Right now, this is just a quick check-in. This is where you're going to be at the end of the first part of the sprint. So right now, the team in this section in first place has about 3,000 of profit. Team in last place, assuming they don't get disqualified, has about a $5,000 loss. Just about an $8,000 difference between the top and the bottom. Okay, nothing that's not going to be changing over the next few weeks, but nonetheless, that's where we're going to score. The grade distribution, if this were the way this were to end, would be first place gets 5 points, second and third place get 4 points, then 3 points, 2 points, 1 point. Okay? And again, the Bloomberg trading competition does not apply towards the final exam opt-out because since it's a relative performance grade, half of you are going to underperform, and I'm not going to penalize you for the final exam opt-out, subject to peer reviews. Now, if a peer review says you didn't participate, you can't opt out the final exam. Right? But nonetheless, the competition itself, as long as your team is not disqualified, does not affect or peer review does not affect the final exam opt-out. All right, hopefully everybody's, looks like you've gotten started working with your team captains. Questions about the trading competition? How to trade, what to trade, etc. All right, remember the trading competition is a lot to do with expectations in the short term, right? Again, as Warren Buffett says, short-term, stock prices are a voting machine. Long-term, stock prices are a weighing machine. Okay, if I'm thinking about a 5 or 6 week time horizon, it's definitely a voting machine. Okay, because things aren't going to play out in that short period of time. I'll give you an example. Last week, we talked about Apple, and a news story had just hit during Wednesday's class. Here's Apple's stock price over the last 30 days. And you can see their stock price was about 190 something. Now it's trading at about 179. Okay, so Apple's taken a pretty good hit on their stock price over the last week because the news had just hit up from China. What was the news again? Yeah. Can't have it on a phone, an iPhone in a government building. Apple gets 1/5 to 1/4 of its sales from China. If they're now caught up in the trade war between the U.S. and China, that's going to be bad for Apple. Okay, and that's what you're seeing reflected here. So the idea is there was a mispriced expectation. All right, the market thought they were going to get a certain amount of sales. They realized that's now too optimistic. Less sales at that high profit margin, less cash flow, less valuation. Okay, so that's the point of the trading competition. What you're looking for is not, is Apple going to make a lot of money? It's, does the expectation change and what does it mean to the stock price? That's how you're going to make money in the trading competition. Another example with Apple's going to happen tomorrow. Tomorrow, Apple's going to release a lot of new devices, including a new iPhone. Okay, and over the next week, there's going to be pre-sales for this iPhone. Next weekend, or sometime beginning of next week, those sales, early sales, pre-sales are going to get published. And if Apple sells a lot more than expected, stock price is going to go up. If they sell less than expected, stock price is going to go down. All right, so that's the point. Like, I can already tell you their stock price is going to change based on what the data says even in the next week about those future expectations of how successful, even early on, their iPhone 15 is going to be. But nonetheless, that's the trading competition, whether it's any stock that we were looking at. In fact, if you're paying attention to Disney, what was the news on Disney today? I guess just a homework assignment on Disney. What was the news on Disney? Yeah.
Came to an agreement with Comcast to continue giving them rights.
I think it was Charter.
Or Charter.
Charter. Yeah, but there was a fight over ESPN and streaming, and there was an agreement today. That will affect things. So that's the point. Like, when there are changes in information, that tends to be what drives stocks. So finding that opportunity is where you'll have some challenges or opportunities in your trading challenge. All right, questions about the trading challenge? What you need to do, how to do it? Again, everybody should be participating. Now, as you do your BMC certification, you should be familiar with the worksheet or W function in Bloomberg. Anybody know what that is yet? Okay, so if I'm looking at the trading competition, the only person that can see the trading competition is your team captain who's registered for it. The rest of the team members can't, okay? But here's a suggestion. In Bloomberg, you can go to W, which stands for worksheet. And I have a bunch of them, but I would suggest creating 2 worksheets, okay? Worksheet number 1, you just create a new worksheet here. It has these default templates, and I'd probably create one either equity buy side or equity sell side by default. Okay? And then create it. It'll be blank. You name it whatever you want, save it. But down here, you can start entering tickers. So let's say I bought Apple. So I'll put Apple in here. And then I bought Delta. So I'll put Delta in here. And then I bought Costco. So I'll put Costco in here. So what you can do as a team is you can list all the companies you bought in your trading competition, and these worksheets are shareable. Okay? So you save it, and you click here on share, and then you just basically put in your other Bloomberg member team accounts that are on your team, and then everybody would see this common worksheet. So if you're trying to track your portfolio, you can essentially build a tracking portfolio of what you just bought. Okay? In fact, you can add columns. You can add a column that says purchase price, for example. So if you even want to put in what I bought it at, and you could actually track actual performance, that would be a corollary to the trading competition that your whole team could see. Okay? So that's one way that your team can kind of keep up on what your portfolio is doing. Then I might recommend creating a second worksheet, trade ideas. All right, so if your team is going to think about, oh, here's some stocks we should buy, put them on a worksheet. Okay, then you could talk about it as a team. So you got a list of potential companies to eventually buy. Okay, so 2 potential worksheets for the trading competition. Again, you could share them with whoever you want. Just put in your team members. Everybody would see that under the W screen. Shared worksheets. All right, questions about that? And what's nice about the worksheets is you can customize them to your heart's content. Basically, when you come in here and you right-click on something, you can insert a column, delete a column, replace a column, and when you do your own column, you can, again, right-click and choose your own function. So I can put pretty much anything on this worksheet. I could put ROICs, I could put growth rates, I could put analyst recommendations, I could put earnings estimates, I could do whatever I want and basically put it on here. And these are just nice trackable worksheets. They just have a few by default to get you started. All right, it's called W in your trading competition. All right, don't forget, Friday, BMC certification's due. Okay, so you have to turn in at least 1 screenshot if you took it more than once, 2 screenshots But the idea is, it's the screenshot showing the percentage completed correctly on each of those 4 sections, okay? And make sure it's above 70. Otherwise, you won't get credit for the certification. So that's what you're turning in by Friday of this week. Any questions about your BMC certification, which I hope you're all doing through the web? All right, today you worked on homework 2, which was on Disney, okay? So as part of homework 2, you did an EIC assignment. Would have gone to Disney. You would have gone to RV. You'd have then gone to Markets Beta. And here is where you would have taken screenshot, save. I called mine, RV-DIS, but you would have turned this screenshot in as part of your assignment, and you'd have had to start with the E, the economy, and use the data on the screen as part of your E. Okay, so given that, what would we have said, what number would we have used, and what would we have said about the economic sensitivity of this industry? So what's the number off the screen that we should have referred to for industry? E. Yeah.
Market cap weighted average raw data.
Yeah, so 1.11. Okay, and so what does that mean? Is the industry sensitive? Yeah.
Yeah, it means like so for every 1% change in the economy, the industry changes 1 hours.
Okay, great. And so the next part would be why. Why is this industry a little bit more economically sensitive? Why is it going up 11% faster and down 11% faster? What makes it more sensitive? What would you have said? Yeah.
I was talking about how like entertainment isn't really like a staple or defensive sector. If we were to go in like a recessionary environment, then people would look to like entertainment and like TV costs, things like that.
Yeah. So I could basically cut my subscription to all these services because you know what? Inflation's high and choice between food and rent and Disney Plus or Hulu. I'm going to cut a couple of those services, right? And so that means that they're probably a little bit more economically sensitive. That's why you see higher betas here. What else might drive the economic sensitivity higher? Better in good times, worse in bad times slightly, 10%, 10, 11%. Yeah.
Say like economic factors like consumer spending or consumer price index, or possibly a recession.
So again, recession, high CPI affects this, great. But I'm thinking at least a couple other things. A lot of these streaming services are based on ads. Is the ad business economically sensitive? Yes, it is. And that's the point. Advertisers cut back in tougher times. They're going to get less streaming revenue from the ads business if we're in tougher times. And don't forget, these companies have theme parks. 75% of Disney's profit, comes from the theme park business. It's not all about the streaming. Is the theme park business sensitive to economic changes? Same idea. People aren't traveling as much, particularly in a consumer-driven environment. In tougher economic times, that tends to hurt their theme park revenue and theme park attendance. Okay. So again, just making a couple of comments, but that's why this industry is a little bit more economically sensitive. Now, what about Disney? Disney's raw beta is 1.15, so we can say that Disney's probably a little bit more economically sensitive, but the same drivers that are probably applying to the industry are also probably applying to Disney as to why they're both economically sensitive. It's not huge. It's not like their business goes away in a recession, but you tend to see a little bit less people. All right, questions about the E and how you'd have answered the E. All right, so you have a question?
Yeah, why is it that when we choose the market cap being greater than like 0, there's less firms being shown?
Why, when we say the market cap is greater than 0?
My default setting, I had the market cap be 0, like in that amber box. But
So you set this market cap to 0?
there's less firms being shown than why it's been placed.
Let's see. Bizarrely, don't know.
Okay.
It shouldn't affect that, but obviously it did. I don't have a good example. Well, make it 200 billion, yeah, it does filter out in the high end, but I don't know why it filters it out the low end. Quirk of Bloomberg. All right, other questions? All right, second screenshot. Just reload the RV. Oh, I think it was 200 million was the first one. There we go. Custom spread. So now in the I, we want to start out with the current spread of this industry. And as it loads, that spread is going to be negative. All right, so this right now is a value destructing, kind of unattractive industry today, okay, with an ROIC of about 1.9% and a WACC about 8.79. So we're looking at an industry that's got about a 7-point negative spread, okay? So that's the point. Using Porter's 5 forces, why? How do those 5 forces help us understand this industry negative spread? Second screenshot, you to turn it. Yes?
I mean, I brought it up to the limited supply power, but like the cost of content, and then I sort of brought up like the writer's strike that happened this spring that actually just like recently got resolved, but that's like pushing the price of content higher.
So let's talk about both of those. So a lot of money being spent on content. How does that help or hurt the spread?
Well, it hurts the spread because like the cost of content is so high, but also losing with like what is it like really destroying the industry because no one wants to spend all that prices on content, and even for the ones that are currently in it, they have to like Disney's not making any profits right now because they're spending so much money.
So I told you last week, and it's really, thank you for bringing that up, BICO can be useful, okay? And Disney is an example. And the other part is not just BICO, which is the Bloomberg Intelligence on a company, but if you go here, you can also see the industry report, which is just the BI dashboard. And if you go through the industry report, where they talk about content, they got some scary graphs. And it's right now, how much money, where was the first one? There it is. How much money streaming services are spending to acquire content. And in 2023, that number is going to be $72 billion just to buy the content rights that are on the services that you're watching. Disney alone is expected to spend $8 billion on content, $500 million less than last year, but nonetheless, we're talking about the industry. So the industry is spending $80 billion, $72 billion just for streaming content. And then when you look at total content for like sports and like ESPN and stuff like that, then the content spend in the later parts of the BI dashboard is like $130 billion on just streaming rights. So huge investment, which suggests a lot of supplier power because they're paying all this money because the suppliers have power over them for the streaming services and the content they're using, even the distribution of their sports services, you know, NFL, etc. So the point is that is putting pressure on the industry. There's a huge amount of investment. Right? Now, what about the strike? Is the strike affecting the industry today? In this historical spread data that we're looking at, is the strike affecting the industry today? Is that why the industry has a negative spread? Do the suppliers have all this power over these players? And I keep using the word today because the strike happened within the last few months, and we're looking at last year's data. So I think on a lagging effect, it hasn't affected that data yet. But when we talk about the future 5 forces, what happens with the fight between basically the content providers, which Disney is in, and the suppliers is going to matter. And if basically these people break the unions, it's going to help them. If the unions break the content providers, it's going to hurt them. So in your future 5 forces, this should definitely have come up. Okay? And today, maybe not as much, but at least it's an issue. And that would affect supplier power. What else about the 5 forces explain the negative spread? rivalry, power buyers, substitutes, barriers, entry, exit. Yeah.
For rivalry, I talked about how there's so many like big players who's trying to compete with each other. And at the end of the day, it's like the same service in terms of like entertainment TV shows. So it kind of cuts into like some of their revenues that they're trying to, or on the expense side, they're trying to spend so much for content acquisition, subscriber acquisition that they're gonna have to offer like cheaper rates or more competitive rates just to stay in the market and like position themselves against all these other giants.
Yeah. And so there's what, 8 or 9 companies listed on this list. They're kind of fighting to get you to be subscribers right now. The rivalry amongst these players seems to be fairly high. And the other part is that kind of gives us buyer power, right? Because we have choices. In fact, what happens if you have your Hulu subscription, you don't want to do Hulu anymore? Can you cancel it? Do you have to pay a cancellation fee? Or you got a month to month? Well, there's the point. It's actually easy to cancel, right? And they could lose you. In fact, what some people are doing is there's like a movie they want to see, they subscribe, they watch the movie, and then they cancel next month. Like you don't have to stay long term. So right now there's not a lot of stickiness with these platforms, and that is something that suggests buyer power. We have power. They're fighting for us. They're making it easy to come in and on and off right now. It's not like signing a cell phone contract where you're locked in for 2 years, right? So again, buyer power is pretty strong. Rivalry is pretty intense. We're paying a lot to the suppliers who seem to have some power over the industry for the content that we're purchasing. All 3 of these are leading to negative spreads, right? Now, barriers to entry, high or low? Yeah.
I would say getting higher given the trends in content spend and the fact that there's so many existing players that have sort of relatively stranglehold on market share makes it harder for somebody to go in and inject huge amount of capital to catch up.
Yeah, I was joking with the last couple classes. I saw an advertisement for Fubo TV. Does anybody even know what that is? What's Fubo?
I believe you like sports.
Have you subscribed to it?
No, but
Has anybody here subscribed to Fubo? At any point? I think that makes his point. Like, it's harder for these kind of second, third tier companies that don't control the content, that can't afford this level of spending, that have been locked out of content because they've signed these agreements for exclusive access to content, that makes it hard for other streaming services to just pop up. So the barriers to entry in this business are pretty high, okay? For many of the reasons of spend, brand, etc. And so therefore, that tends to help the industry. And right now, it's not leading to a positive spread, but it is a favorable force to the industry. What about substitutes? Are substitutes hurting this industry right now? Yeah.
could there be substitutes in terms of like things that customers can spend on otherwise, like spend on discretionary spending?
That's exactly what a substitute is. So what would be an example of a substitute that might be hurting streaming? Yeah.
Well, I said cable, but I wouldn't say would be hurting it. I said the opposite, like cable was the substitute, but now everyone's going to streaming.
Yeah, actually, if you read, it was the industry BICO or the company BICO, it talked about how cable has now hit a tipping point where they're just losing so many subscribers and becoming much less relevant because we're perfectly comfortable now with streaming. And cable's really getting hurt in this business. Somebody in the back have another substitute?
Going out to see movies.
Yeah, you got regular movies, potential substitutes. Gaming is a substitute to this industry. Like if people look for other forms of entertainment and they don't buy the streaming services, that's a substitute. Or, and I don't understand this phenomenon, but I know people who will watch TikTok for like 10 freaking hours a day, every day. I don't get it, right? But some people just get lost in it, right? And I'm just telling you, that's not this, right? Because if I'm lost in my TikToks or I'm lost in those Facebook videos, I'm not paying attention to what's going on in these services. I'm definitely not subscribing to those services. So those are substitutes, which to some degree are a threat to the industry. Okay? Now, whether it's making an impact, probably around the margins, but that's something we consider as part of our payment. Now, the next part is very important as well, which is, did you talk about theme parks? Because like I said, 3/4 of Disney's revenue comes from the theme parks, not the subscription services. So Disney World is far more important than Disney Plus. What would we say about the 5 forces for the theme parks? Is it different than these streaming services? And I'll give you a hint. They make a lot more money on theme parks than they do on Disney Plus. Theme parks are a much more profitable business. Disney World, Universal Studios, Six Flags, SeaWorld, those types of things. Are the barriers to entry pretty high for theme parks? Yes, they are. You build a Disney World in, where are they? I think there's one in Tokyo. Is there one in Shanghai? It's $1 billion. I mean, these are not cheap things to build, these global theme parks. So huge barriers to entry for those. Then you got to have a brand that people want to come and travel to them, right? So huge barriers to entry. Not a lot of rivalry for these theme parks, right? The theme parks themselves. I was joking, but it's on my truth. I just bought tickets for Halloween Horror Nights at Universal, going October 13th. It's friggin' expensive, okay? Everybody even know what that is? It's the world's largest Halloween party. They shut down the park and for 6 hours a night. It's 10 haunted houses, biggest haunted houses in the world, professionally done. So it's really cool. But the point is, it's really expensive, right? Just like Grinchmas, right? Which is the Christmas version of that, right? And then you also have Disney itself. Like, it's really expensive to buy tickets now for these parks. So that's the point. There's not a lot of rivalry amongst the players. They don't compete on price. They're like duopolies, right? They're all very, very expensive. So you don't have power over them, right? And that's the point. It's hard to substitute right now physically going to a theme park. Maybe in 5 years we'll do more virtual reality stuff, but I don't see that happening anytime in the near future. And so therefore there's not a lot of power over buyers. The buyers don't have a lot of power here if you really want to go. And so that business is a little bit more favorable, right? But they're spending so much money on content and streaming that right now it's kind of over swamping the boat from an ROIC perspective. That's what's driving the spreads very negative, right? And you can see that, by the way, if you go to Disney, go to RV, which we didn't do for Homework 2, but foreshadowing, you will be doing for Homework 3 and beyond. We did it on the whole firm. If I click on this whole firm dropdown and I just look at my entertainment facility peers, it's a different list. So here are the theme park peers. And if we excluded Disney, treat it like an exclusive average, because Disney is part of this list. But if you look at the performance of the other theme parks, related companies, their spreads are actually pretty high. So that's the point. Disney, which includes all the money they spend on streaming, is not doing so well because they pay so much right now for content. But if you take out that content, the rest of Disney is actually doing pretty good because this is a much more favorable business. Okay? Versus all the people that are in the film and TV part of the business, that's the part of the industry that's suffering. So in a way, for Homework 2, you should have done 2 5 forces. You should have done a 5 forces on the film and TV, and you should have done a 5 forces on the theme parks, because Disney is in more than one business. Now, I didn't ask you to do that in Homework 2. You just process assignment, learning how to do it. You should at least reference the 2, okay? But starting in Homework 3, we're going to have to look at the multiple segments of a business and do industry analysis by segment, okay? Because the segments aren't always the same 5 forces. And then the other key question, just back to Disney, is will any of this change in 5 years? Will these spreads change in 5 years? So therefore, is anything about these forces going to change? Like, is the buyer power going to change for Disney in the next 5 years? Do you think you're going to have more buyer power than today or less? Just talking to you about streaming. Are you going to have more or less buying power in 5 years? What do you think? You, the customer.
More.
Why?
There'll be more options in the
Okay.
future.
So you think there's actually even more options, and that's going to give the customers more power, right? Well, that might actually help flip the spread for the industry more negative. Yeah.
Less, because they're gonna start like they've already started cracking down on other devices a lot, like per new company, and then I think also like how many units they use for your free trial.
So if you listen to each of you, you both have a different point of view on where the industry can be in 5 years. That's okay, because we are dealing with the future, and you could both potentially be right. So that's the point. If we're grading this, it's not that I agree with you or disagree with you. It's, did you list that scenario, talk about the impact with reasonable data. Like, that's what I need you to do in your assignment, okay? As you're talking about the future 5-year forces. You've got to have a point of view, you've got to talk about in the context of reasonable data, talk about how that data and those assumptions change that force or don't change that force, okay? Same thing. You could argue that the barriers to entry are going to stay high. You could argue that the rivalry will get less. These become more monopolistic. Prices are higher, right? They've locked out the ability to access certain types of content. That tends to favor them. So if you want to watch a certain TV show or a certain type of movie, there's only one place you can get it. You got to pay for that service. Well, that tends to lock you in. Maybe they change the nature of their business model, and you are signing longer-term contracts for these streaming services, right? With penalties. That could take away from the power, and that could flip things around. Okay? Same thing with the theme parks. Anything going to change in the theme parks in the next 5 years? My sense is they're actually a fairly attractive business today, and they're probably going to stay fairly attractive in 5 years. Okay? Because a lot of new theme parks aren't going to pop up. And in the next 5 years, kids still want to go to Disney World. Okay? They still physically want to go. And parents are going to be driven to do that because there aren't really viable alternatives to that right now, and not probably in the next 5 years. So that tends to bode well for the theme park part of the spread staying fairly high. And I think the content, that's the whole point. Can they get enough growth? And right now, that's what the BICO was talking about, is it's the growth that the industry's struggling with. We're not growing and adding as many subs for streaming today as we did last year. And so the question is, how do you kind of perpetuate that growth? And there's just not enough consumers to go around to buy all these services. So that, to me, suggests there's probably going to have to be consolidation. You're not going to see 10 different streaming services last. Okay, you're going to see like a top 3 or 4, and then the rest. They're going to be like 80% of the market. And so how well can they do? And that suggests that they're going to probably have some pricing power, because if they've locked up all that sports content and you're a fan of sports, you're going to pay up for it, just like you did with cable. Okay, and they're essentially rebundling the idea of taking out the bundle. They're just recreating it online in an online platform. Okay. But nonetheless, that's the types of things you should be talking about. Now, on this data, does Disney have a competitive advantage? Now, somebody in the first class said, well, they have like all the Disney cartoons in their library, you know, Snow White, Cinderella, yada, yada. They got the Marvel movies, they got the Star Wars movies. They clearly have competitive advantage because of that. But is that showing up in the numbers today? No, the $8 billion they're spending for content is dwarfing the returns on their platform given the subscriber base and prices today. So that's the point. Like, yes, they might have potential competitive advantage, but they're not demonstrating it today. They're actually underperforming the industry and the industry spread. Their spread is a little bit worse than the industry. Okay, so that's what you should be talking about today. Now, for 5 years from now, that could be the reason why their spread eventually turns positive, and they start doing better than the industry because they have these great brands, which they're able to monetize, which then they'll start making more money when they actually get the volumes and prices that allow them to monetize that. That's very legitimate to say about Disney, but they're not doing it today. In fact, I would argue some of the opposite. There's this show on Disney Plus, which I subscribe to, and I'm thinking about canceling, because they got the Marvel show, or the Star Wars show, what was it called? Ashaka or something like that. I have zero interest in watching this. I heard it's pretty good. I am all Star Wars out. There's not another Star Wars show that I really want to watch. Same with the Marvel movies. The Marvel movies now just suck. They're just awful. They're god awful. They're hard to watch. They're painful to watch. They're just not intended to me. Now, some of you might be like some sort of hardcore comic book fan, and you really, really love what they're doing, but I think they're getting away from their mass market appeal of the last decade, and that's the point. Like, I'm just getting superheroed out, I'm getting Star Wars'd out, and that's what Disney's brand is all about. And so the question is, in 5 years, like, if that content is just not appealing to the mass market, because we're just kind of tired of it, well, that's not good for Disney. It's not good for their competitive advantage that they kind of bet their whole company content on. Because I just think they have too much too fast. There's just too many shows, right? Because that was the whole point. Like, 10 years ago, you get like one movie every 3 or 4 years. That was intentional, so that there'd be some anticipation for it. Now you're getting one movie every 3 or 4 months. There's just so much of it. I think it's overwhelming people. So that's something that they got to rationalize. So what I'm telling you is you can have two views of competitive advantage. I might be wrong, and they might just be a cash juggernaut with these shows over the next 5 years. I might be right, and that threatens them. Those are two different levels of competitive advantage that could really affect Disney on a go-forward basis. Now, theme parks, I have a hard time believing that people are going to suddenly have this big negative view on Disney World. No one's going to want to go. So I think that competitive advantage is very sustainable. I don't think much is going to change in the next 5 years about Disney World being one of the best brands in the world for that, in terms of where kids go worldwide. Right? But nonetheless, those are the types of things you should be talking about yourself. EIC. Questions? For the first one, the teenager could be a little bit easier on the grading. If you didn't talk about theme parks and you only talked about streaming, we're not going to dock you all the points for that. Okay? If you only did the whole industry, that's fine. Right? But nonetheless, Disney did have multiple segments. You should be addressing more than one segment. Starting with homework 3, you have to talk about multiple segments. So let's talk about homework 3. Homework 3 is in a company called RTX Corporation, also previously known as Raytheon. Basically, RTX is a merger between United Technologies and Raytheon. Okay? So half their business is defense and aerospace. The other half of their business is commercial aircraft. Okay? So for example, there's a war going on in Ukraine, horrible headlines where every night the Russians are basically bombing the civilian Ukrainian cities, trying to kill everybody, stop all their grain deals, stuff like that. The Ukrainians are shooting down the Russian missiles using something called Patriot missiles. Raytheon makes those. Okay? So Raytheon is missiles, radar, cyber defense. That's half their business. Mostly to governments, right? But not just the US government, they sell that around the world. And they're very good at what they do. Patriot, probably the best anti-missile system in the world. That's what you're seeing it play out in Ukraine every night with all the missiles that they're actually shooting down that don't hit the Ukrainian cities, okay? But that's all Raytheon, right? Raytheon also makes commercial stuff. One business is called Pratt & Whitney. They make jet engines. So if you fly a Boeing 737 or an Airbus 320, Pratt & Whitney engines on it, that's their product. And they have Collins Aerospace, which makes the parts to planes. Okay, so half the business is selling parts to Boeing, Airbus, Bombardier, or whoever. Half the business is selling engines to them. The other half of the business is selling basically military stuff to the US and other companies. So kind of two types of businesses. So when you do RTX, and I talked about this in the RV, if you don't know anything about them, DES, but here in the drop down, you're no longer doing whole firm. You'll do a defense and you'll do an aircraft and parts manufacturer. When you do an RV markets beta for defense, you're going to get a different industry beta than an RV markets beta for aircraft and parts manufacturing. So 2 screenshots, not 1. Yes, sir. I'm sorry? You should do location, country
Oh,
domicile. Local and country domicile would essentially be the same because they're U.S. companies. All right, but I'm going to put the instructions to use location and domicile. Okay? But these are just U.S. peers. So you're not looking at, for example, European defense companies won't be part of your list. These are U.S. centric for this exercise. All right, so this screenshot is going to be doubled. 2 E's, 2 I's. You'll have a spread for the defense industry and a different list of competitors, then a spread for the aircrafts and parts manufacturing industry with a different group of competitors, which means you're going to do a 5 forces on defense and you're going to do a 5 forces on aircraft and parts today and in 5 years. You're going to do a different economy for each of those 2 segments. Competitive advantage could be different today, 5 years, but you're going to have 5 screenshots and you're going to have a longer paper. Okay? And again, I really strongly suggest looking at the BICO and the industry research report. Matter of fact, you can see Raytheon's RTX's stock is way down today. Does anybody know why? This could be something you'll be talking about. It's going to affect them and the industry. So, without being morbid, I don't know if everybody's seen this, but when somebody passes away, they would cremate them now more than bury them. And there's this kind of newer thing where you can take somebody's ashes and press it together and make something like a diamond. It's almost as hard as a diamond that you can wear. So you can actually wear a relative around your neck or other jewelry. They'll kind of take the ashes and turn it into things. To me, I'm not interested in doing that, but that's something that people are starting to do in the real world, because you can take particles, put them together, and make something very strong and hard, right? The reason why I'm telling you this story is because RTX does that with the manufacturing of jet engines. And about a month ago, it came out that in the process of taking these powders that are pushed together to make specialty materials to make these engines, some of the powder wasn't actually staying hard, and powder residue was actually spreading out in the actual engines. And it's a safety concern because the engine can literally blow up and fall out of the sky. So RTX has A320 engines where they found a manufacturing defect. And every A320 everywhere in the world has to be pulled out of service for inspection to find out whether it has these powder in it. And we're talking about thousands of planes. And they originally took a $500 million hit to compensate the airlines for this potential safety defect problem. Okay? Today, they said that that initial estimate was low, and they now think that the safety estimate is going to be $3 billion, because these planes are going to be out of service for hundreds of days each while they're inspected and fixed. Well, that's a real big deal to the airline industry, because that means in an airline industry where there's full flights, the airlines are going to lose a bunch of planes for inspections and safety fixes that were completely unexpected, which you want them to do because you don't want to be flying around when the plane engine blows up. Okay, but nonetheless, that's going to affect RTX. That's why their stock price is down $6 today, because they just announced that. And they also announced that because of that, there's a lot less sales coming out of their engine business because of the potential quality problems that they're having. Okay, it's good for Boeing, which makes, good for like Rolls-Royce and GE, which makes engines, bad for RTX. But regardless, this is going to affect, for example, competitive advantage. Okay, and to some degree, it might even have an industry profitability impact. But regardless, I say these things because these are the types of things you should be talking about when you're talking about a company. Like the real world implications on the I and the C, in this case, Raytheon C, by the quality problems that they're having, and these quality problems. So you just get a little foreshadowing on this one, right? But remember, they have two parts of their business. They got defense, they got commercial. It's about half and half. So you're going to be writing a longer paper using more data, right? That's homework 3, individual, due next Monday, 10 a.m. Okay? Questions about homework 3? So this week, you have a longer version of the homework, so I'm not worried about people going past 500 words on this one. So minimum 500 words, 4 screenshots, not 2, talking about essentially double the information on the I and the C, potentially, and the E, on the E and the I, and that's an RTX Corp. Okay? Due Monday, 10 a.m. By Friday, you got to finish up your BMC certifications. All that needs to be done by Friday. Okay? So, we're not ending class yet, but Wednesday, no lecture. That's a Bloomberg Lab day. I'm giving you Wednesday to work on homework 3 and to work on your certification. But specifically, the lab will be open, room, but between 11 and 5, there's no lectures. So if you need to go grab data, you can come here anytime on Wednesday. The lab should be open, and hopefully the terminals are available to you. Okay? So no lecture on Wednesday. Our next live lecture, where attendance will be taken, a week from today, next Monday. Questions about that? All right, so the last thing I want to do before we leave today is in Elms, there is a folder under the Files folder called September 11 in Class. And there are 2 files in there. One's called keyvaluedriver.pdf, and the other is keyvaluedrivers.excel, XLSX. Okay? I want you to download those 2 files. Now, this is not going to be done for a grade, but you're welcome to work ad hoc, teams of 2 or 3. One person download, you can all talk to it. The PDF is a series of things to do to the Excel file that go through 6 scenarios. And these are the 6 scenarios of the key value drivers that we talked about last week. Okay? So key value drivers in action. And what I'm telling you is at a high level, if you understand these 6 scenarios, you'll have a pretty good idea of what's gonna happen with the values of companies, okay? So I think it's good to have just kind of a conceptual understanding before we continue to get more detailed on all of these things. So high level key value drivers. So I wanna do that exercise kind of in class, give you about 15 minutes to work on that, do the 6 scenarios, answer the questions, and then we'll talk about it, and that'll be the last thing we'll do in class today. Make sense? All right, have at it.